Ever feel like you're just swimming in financial news? Endless articles, predictions, the market going up and down. It's a lot. You just want someone to cut through all that noise, right? Get to what actually matters for investing. Well, that's exactly what we're aiming for in this deep dive. Think of it as a shortcut to getting genuinely informed. We're digging into a real cornerstone text, Benjamin Graham's The Intelligent Investor. It's classic practical counsel, updated with commentary by Jason Zweig. And this isn't about hot tips or predicting the future. It's about principles. Timeless stuff.
Yeah, exactly. Our mission here is really to pull out the absolute core insights from Graham's wisdom and see how they apply today. Because honestly, these principles are still incredibly relevant and frankly quite liberating once you grasp them. They can really empower you.
Okay, so let's start with Graham himself. Where did this wisdom come from? He didn't just appear, right? He started out as a Wall Street clerk, climbed the ladder analyst, partner, eventually ran his own investment firm. But he learned some tough lessons early on, like April 1919, Savold Tire, he made a 250% return on day one. Amazing, yeah.
Wow, sounds great.
Until October. Turns out the company was a fraud. Stock became worthless. Poof.
Ouch. Yeah, that's a hard lesson, a very hard lesson.
Definitely a crash course in market dangers.
And you see how an experience like that would shape you. It pushed him towards, well, meticulous research.
Yeah.
Looking way beyond the hype. Like his discovery in 1925 with Northern Pipeline Co. He's digging through these obscure reports, right? Finds the stock's trading at $65. But hold on, the company holds at least $80 a share in good bonds.
So the assets were worth more than the stock price.
Way more. So he buys in, actually pushes management for bigger dividends, and boom. 3 years later, he walks away with $110 a share.
Now that's investing based on analysis.
Exactly. And that brings us to Graham's definition. It's so precise.
An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Let's break that down. 3 key parts. First, thorough analysis of the company. You got to do the homework before buying.
No QAnon.
Second, deliberately protecting against serious loss. Safety first. And third, and this is kind of radical, aiming for adequate, not extraordinary returns. Why is just adequate so important?
Well, it fundamentally changes your mindset, doesn't it? It pulls you away from gambling towards calculated risk. Graham was really clear. Stock trading isn't investing. He called that speculation, pure and simple.
Okay.
See, investors face roadblocks. Partly it's just human nature, our own biases. Partly it's the market itself. If everyone knows a company's doing great or expects it to, that good news is usually already baked into the stock price.
So buying based on common knowledge often leads to disappointment.
Often, yeah. The market's already priced it in.
That sounds like the danger of the crowd mentality. Graham even used Sir Isaac Newton as an example. I mean, one of the smartest people ever, right?
It's genius.
But Graham said Newton acted like a fool, investment-wise, during the South Sea bubble. He let the roar of the crowd cloud his judgment. Lost a fortune.
Even Newton. It shows how powerful that pull is.
So if we shouldn't follow the crowd, how do we figure out what something's really worth when everyone else is, shouting different prices? Graham gave us this brilliant metaphor for it. Mr. Market. Picture him like a business partner you have. Super obliging guy. Every day he shows up, tells you what he thinks your share of the business is worth, and offers to buy you out or sell you more at that price. No pressure either way.
Right, but here's the catch. Mr. Market is, well, he's moody. A bit manic-depressive, you could say. His valuations are often just plain silly, driven by wild enthusiasm one day, crippling fear the next.
So when stops are hot, he's like, I'll pay anything. Overpays.
Totally. And when they're crashing, he's desperate. Get me out. Sell it for cheap. Undersells.
Okay, so the intelligent investor sees this and uses it.
Absolutely. You use Mr. Market's emotional roller coaster to your advantage.
Buy when he's panicking and selling cheap. And maybe think about selling when he's overly euphoric and offering a crazy high price.
It sounds so simple, doesn't it? Buy low, sell high. But why is it so hard in practice? Even for the pros?
Yeah, good question.
Well, think about typical big money managers. They're managing billions. They almost have to mimic Mr. Market sometimes. They buy high, because everyone else is, sell low when panic sets in. They often gravitate to the same few huge overpriced stocks because that's all they can buy in the size they need.
So they're kind of forced into herd behavior by the sheer scale they operate at.
In many cases, yeah, it's a structural constraint.
Okay, so shifting gears a bit. For someone wanting to be what Graham called a defensive investor, what are the key strategies? He said the return you aim for should depend on the intelligent effort you're willing to put in, not just how much risk you take.
Yeah. Effort, not just blind risk. For a core portfolio, he liked keeping it simple. Historically, something like a 50-50 split between bonds and stocks worked well. Gave around 6% a year, historically speaking.
Okay.
And importantly, that stock part usually gives you a decent hedge against inflation eroding your buying power over time. Though, no guarantees.
Right. Inflation is definitely something to plan for. It's not theoretical. I mean, look back. Cost of living almost doubled between 1915 and 1920. Jumped 15% between 65 and 70.
It's always there, lurking.
So you should always assume continuing or recurrent inflation, maybe a tiny bit of gold as insurance, like 2%, maybe 5% if you're over 65, through a diversified fund, of
A
course.
small hedge, yeah.
Yeah.
It's an option for some peace of mind.
What about strategies for actually investing the money?
Dollar cost averaging. This is powerful for the defensive investor, like a permanent autopilot.
How does that work?
You just commit to investing a fixed amount, say $500 every month, maybe split it across a few broad index funds, U.S. stocks, international stocks, U.S. bonds.
Okay, regularly, same amount.
Exactly. It stops you from doing two dangerous things.
Nice.
Throwing all your money in when the market feels exciting but is actually high and risky.
All right, FOMO investing.
Yeah. And it also stops you from freezing up and refusing to buy when things look scary but are actually cheap.
Yeah.
It takes the emotion out.
Graham also had this really strong warning about trading too much. He basically said if you're trading more than twice a year or spending more than like an hour or two a month on your investments, something's wrong. He said the defensive investor wins the race by sitting still. That sounds really hard today.
Oh, it's incredibly hard. The temptation to constantly tinker, check prices, react, it's huge. But his point is about discipline, patience. Let the strategy work. And for the bond part of the portfolio, focus on quality. Choose taxable or tax-free based on your tax situation, obviously. But stick to high-quality ratings. AA, or A for Moody's or S&P.
Yeah.
Safety first, remember?
Right.
He also mentioned things like income bonds may be stronger than preferred stocks sometimes, but often overlooked just because of, tradition.
What about those exciting growth stocks, the ones everyone talks about?
Yeah, Graham was wary of those for the defensive investor, called them too uncertain and risky.
And we've seen why, haven't we? Think about the dot-com bust. Microsoft stock dropped over 55% from 2000 to 2002. Cisco lost 76% in the same period. And their earnings didn't fall nearly that much.
It just proves the point, right?
Yeah.
The hotter they seem, the harder they can fall when sentiment shifts.
So this forces us to rethink what risk even means in investing.
Exactly. Graham reframed it. He said real risk isn't just market ups and downs. Real risk is, 1, actually losing money because you sell low. 2, loss because the company itself fundamentally deteriorates. Or 3, and this is the most common one, risk comes from paying too much in the first place, and excessive price.
Paying too much.
Yeah. His insight was, if you have a diversified portfolio of well-chosen stocks, bought at reasonable prices, and it provides a decent return over many years, then it has proven itself to be safe, even with all the bumps along the way.
Okay, what if you want help? Financial advisors.
Graham's advice is timeless. Investigate. Before you hand over any money, check if the advisor is trustworthy and if their fees are reasonable.
Makes sense.
Get referrals from people you actually trust. And watch out for red flags like anyone saying, just trust me, or nobody else knows how to do this. Big warnings there.
Let's dig a bit deeper into analyzing companies. Graham talked about challenges here.
Yeah, one big issue is that complex math, those valuation models, they've become really popular exactly where they're least reliable.
Like with
those fast-growing stocks we mentioned.
Yeah.
Their value depends so much on predicting the distant future, which is just inherently prone to big miscalculations and errors.
So less predicting, more finding current value, like his bargain issue idea.
Exactly. That was classic Graham. Finding a stock selling for less than just its net working capital, basically, the current assets minus all liabilities.
So you're getting the cash, receivables, inventory for less than they're worth on the books.
Right. And essentially paying nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items. He saw that as a safe and profitable way to find real bargains.
But companies can play games with their numbers, right? Make things look better than they are.
Oh, absolutely. Investors have to be wary of special charges and accounting tricks that distort the real earnings picture. Think of Global Crossing back in the day, treating construction costs like depreciable assets to inflate profits, or Quest having to restate its financials.
So if even big companies do this, how does an average investor see through it?
Well, one tool is shareholder influence. You actually have more power than you might think.
Like what?
Graham believed in activism. You can vote against directors to show disapproval. You can go to the annual meetings.
Okay.
Now you can even rally other investors online. Graham also floated the idea of having truly independent directors who report directly back to shareholders, not just management.
What about companies just sitting on huge piles of cash, like Microsoft back in 2002, $38 billion, growing by $2 million an hour?
Yeah, Graham would argue that hoarding cash like that often produces lousy returns for the actual owners, the outside stockholders.
Yeah.
It benefits management more, perhaps.
Right. And Microsoft did eventually start paying a dividend, partly due to that kind of pressure.
Exactly. Shareholder interests eventually won out.
You also mentioned companies sometimes prefer buying back stock instead of paying dividends. Why is that?
Well, it often comes down to executive compensation, stock options, right. Options count as a compensation expense for taxes, but often not on the main income statement companies report to the public. So buybacks make earnings per share look better, which can boost the stock price and the value of those options.
So it helps management's pay packet, even if the stock is already overpriced.
It can incentivize buybacks even when it's not the best use of shareholder capital, yes.
Let's look at some specific examples. You mentioned Cisco versus Cisco.
Yeah, classic case study, 2000 to 2002. Cisco. Super hot tech darling, lost 3/4 of its value.
Ouch.
Cisco. Boring food distributor, consistently profitable, gained 56% in the same period.
Wow. Quite the contrast.
Or Yahoo versus Yum. Brands, same story, tech flair versus steady food conglomerate. CMGI, the dot-com incubator, lost like 99.4%, while boring old CGI, the IT consultant, delivered a 60% gain.
Incredible differences.
And that last one, Real Estate Investment Trust versus Realty Equities Corp. Similar names, totally different outcomes. One, a solid dividend-paying trust since 1889. The other, full of reckless expansion, financial legerdemain, ended up suspended from trading.
Goes to show you really need to know what's behind the name.
Absolutely. Dig deeper.
Okay, all this leads us to what Graham called the central concept of investment, the big one.
The margin of safety.
Explain that. What is it, really?
It's basically the buffer between what you pay for a stock and its underlying earning power or value. Think of it like the difference between the expected return on the stock and the safe return you'd get on a bond.
So it's a cushion.
Exactly. A cushion to absorb mistakes, bad luck, or just plain unsatisfactory developments. Things don't always go as planned.
And not having that margin of safety, it can be brutal, right?
Oh, the cost of loss is huge. Let's say you pay too much. The stock drops 50% in year one. Even if it then starts doing great, maybe double the market's return from that point on.
Yeah.
It'll still take you over 16 years just to catch up to where the market would have gotten you without that initial huge loss.
16 years just to break even relative to the market. Wow.
That's the power of avoiding big losses. That's the power of the margin of safety.
Graham had this really provocative idea about where risk actually comes from.
Yeah, it's profound. He basically said financial risk resides not in what kinds of investments you have, but in what kind of investor you are.
Not the stocks, but the person buying them.
Right. He even said, if you want to see risk, go to the nearest bathroom and step up to the mirror. That's risk, gazing back at you from the glass. It's about controlling yourself, your emotions, your decisions.
That ties into something called Pascal's wager.
Yeah, Zweig makes that connection in his commentary. Think about those folks in 1999. A Money Magazine survey found almost 1 in 10 had 85% or more of their money in internet stocks.
Whoa. All in on the bubble.
They ignored the margin of safety. They essentially took the wrong side of Pascal's wager. You can't control the probability of being wrong, but you absolutely can control the consequences if you are wrong by building in that margin of safety. Don't bet the farm.
And Warren Buffett, Graham's most famous student, really lived this, didn't he?
Absolutely. Buffett always talks about the investors from Graham and Doddsville. They're always buying the business, not buying the stock.
Looking past the ticker symbol to the actual company.
Right. Exploiting that gap between the market price, driven by Mr. Market's moods, and the real intrinsic value of the business.
He used the Washington Post Company in 1973 as an example. Market valued it at $80 million. But Buffett figured its assets were worth at least $400 million.
That's a huge margin of safety right there. That's a Graham and Doddsville investment.
Okay, so wrapping this up, if we boil down this deep dive, the core message is what?
I think it's that true intelligent investing isn't about predicting or timing the market. It's not about chasing hot stocks.
It's more disciplined.
Yeah, it's about discipline analysis, always focusing on protecting your capital first, and maybe most importantly, controlling your own emotions, not letting Mr. Market dictate your actions.
Remembering the real value is in the business itself, not the stock price flickering on a screen.
Exactly.
Yeah.
And always building in that margin of safety. It's paramount.
So the final thought for you listening, as you look at your own finances, what lessons from Graham will you apply? How will you make sure you're acting as the intelligent investor, especially when Mr. Market gets emotional and tries to pull you along for the ride?